we often have different interviews, different things that we're doing, and today is going to be a very, very special one. So just waiting for you guys to get going. Okay, Youssef is rocking and rolling from Toronto. Welcome. Dorothy from Texas, San Antonio. Good to see you. Jerix from Aura. I think that is Scunthorpe. Okay, cloudy but dry. Okay, that's standard summer afternoon in the UK. Good to see you. Who else we got? Okay, they're piling in here. Alberto, how's it going? Antonio, welcome. Solomon, Chris Kauflin from the cafe in Maine. Welcome, Chris. Penty in Finland. 28, so having a nice summer there. Awesome. Brian, Alan, D, Matthew, Alberto, Debbie, Anna. Hey, guys, it's so great to have you guys here. And I am very much excited. Now, before we get started, I do encourage you to get comfortable. I'd actually encourage you to grab a pen and paper and to take notes as we go through the session, because there is no doubt going to be a lot of things that you'll be able to learn from today's session. The idea is to help you guys get your minds in order. And no doubt there'll be a lot of cool stuff for you to glean for today. So without further ado, Pete, are you ready to rock and roll?
I'm ready to rock and roll, guys. So today we're joined by someone with a rare skill, Deryck van Rensburg. He manages just over 6 billion Rand, which is around $328 million USD for high net worth clients. He basically tells them what to do with their money. But what's really interesting is how he does it. So he's helped start hedge funds, allocate funds to them, invest in property, set up offshore accounts, and he trades the markets himself and finds smart ways to grow and protect his clients' money. I have firsthand seen him execute trades on a Friday afternoon over some beers with me. So it was a lot of fun. So in a world full of noise, he knows what actually works. And if you've ever wondered how the wealthy think about money, this is your chance to find out. So thank you so much for joining us. And I want you guys to please welcome Deryck.
Thanks, Pete.
Awesome. So welcome, Deryck. So without further ado, let's just dive in. And I think let's go back to the beginning. So I think actually let's just do a quick headline. So what do you do right now? If we can just kind of get started with the main headlines of what you do on a day-to-day basis, what does that look like?
Thanks, Zach, and thanks to the Trading Academy for having me. I appreciate it. I think to put it in a nutshell, where I sit today and what I do on a day-to-day basis is I obviously am based in South Africa, and I look after high net worth individuals' money. And I, as you mentioned, got a sizable book where we've got to look at opportunities. So, as you can imagine, being within the context of South Africa, it's quite difficult to make money in the South African market if you just think about the economic backdrop and the political headwinds that we've had to face, etc. So one of the sort of stances that I took in the early days, many years ago, was to dollarize my clients' wealth. And a lot of the wealthy individuals within the context of South Africa, give them a global look and feel as to where to invest. I've always used an analogy that if you sit on the moon and you look down on Earth, where are you going to invest your money? And I think South Africa represents less than 1% of the sort of overall economic contribution to growth if you just look at world economics. So sitting on the moon looking down, you've got to look for growing economies and cool things, and obviously looking for themes that may play out. Is it the East? Is it emerging markets? Is it developed world markets? What's happening in the tech space? So really what I've done is help my clients to become global investors, look at structures, meet with them on an ongoing basis, and then obviously make the investment decisions behind that. Look for things that are going to really ultimately make them money at the end of the day. Not necessarily all in equities. There may be some private equity investments. I guess my job is really just to hold their hands and to introduce them into money-making ideas on an ongoing basis. So that's what I kind of do on a day-to-day basis. My expertise has been very much in the listed equity space. So following global markets for a few years now, many years, and then kind of looking for the next big thing and obviously those money-making ideas.
That's awesome. So a lot to unpack, and we're going to dive into. It's actually a great overview because we're gonna actually discuss all of this stuff today. So super excited. I think to get things going, let's go back to the beginning. So, where did you start your life? I think let's just get a brief introduction as to who you are and kind of where you began, and then we can shift into how you began with the world of finance and how you got into that.
Yeah, so I think, coming out of school and going into university, I think it was actually during my sort of the latter part when I was finishing school that I got a real interest for the stock market. And it was more the local stock market in South Africa. So if you go back 20 or 25 odd years, you can imagine South Africa is a very resource-based economy, lots of listed mining companies. And going back 20, 25 years, that was a really hot sector to kind of make money. And I kind of started watching the share prices. My late dad actually worked in the mining sector. So I kind of watched him buy and sell a few shares, and it really sparked my interest from an investment perspective. So I started to put some money away and build up a portfolio for myself, and kind of get exposure to it. And then went into university, studied a investment management degree, which was obviously very theoretical based, and eventually started out my career about a year before or about 2 years before the financial crisis, and jumped into it and started managing people's money and obviously building up a client book after doing all the regulatory exams, etc. And off I went. So, it was very much driven by a passion and driven by, the love of the stock market and equities per se. I think it's really pivots around the desire to make money ultimately at the end of the day. And there's actually no better feeling than, coming up with a great idea and making money for clients, and giving them those money making ideas. It's a great feeling. It just so happens that in this industry, the cherry on top is actually money, and that's actually the byproduct of, the homework and the work that you do to come up with these money making ideas.
That's interesting. And so when you first shifted into, so you left university, you shifted into your first kind of positions, what were they like? Like, what were you doing on a day-to-day basis? What did that look like when you first began?
Look, it was a very different world for South Africa back then. So I think my introduction was very much only into the South African market and understanding the push and pull factors that were driving share prices at the time. So if you just look at the JSE, which is our regulated stock market from a South African perspective, it was had a lot more activity 20 years ago or 25 years ago than it does actually today. So there were quite a lot of money-making opportunities, and there was lots of excitement. But, South Africa's changed, and, if you're not evolving and you're not accepting that you as an individual need to change and change your process in terms of how you look at the investment arena, then you're not growing. So, then you slowly over time look to pivot away from South Africa, and look to dollarize. I mean, if you just go back 20 years, I can't even think where the rand dollar was. It must have been 5 rand to the rand dollar. If you weren't dollarizing your hard-earned rands in those times, then you would have been left behind just from a currency perspective. So it was a lot of evolution that took place slowly over time. I went into the corporate, and after my time at the corporate, about 5 or 6 years, maybe a little bit longer, I decided to leave and start my own business, and build up my client book in my own business and start to take a different view of investing, as opposed to just looking at the South African market. And that business really gave me where I'm still am today. That business really gave me the platform to take a different view of investing, in terms of looking at the global arena, emerging markets, developed world markets. Is it the Eurozone? Is it the US? What are the best currencies to be in? So it started to open up my eyes to really giving clients ultimately the best advice from a South African context.
Interesting. And I want to speak. I actually want to make a bit of a side shift and speak about the clients that you ended up getting involved with. So, what type of people are you working with? What type of people are you getting involved with? Who are these people, and where do they get their money from? Like how does that work?
No, it's a good question. So, if you just look at South Africa as a landscape from a business perspective, you'll be quite surprised how many entrepreneurs there are from a South African perspective, and how good these entrepreneurs actually are. If you just look at some of our top listed businesses on our local exchange, we've really got some really successful and some really great entrepreneurs. So to answer your question, a lot of the clientele and the way that I've kind of built up the book of clients that I manage has been very much entrepreneurial people, that have got a flavor for creating substantial wealth for themselves in the line of work and the business that they do. And they obviously come into, liquidity events, whether it be dividends or the sale of a business or, some corporate finance type transactions that equate into delivery of listed shares. Those are the type of clients that I typically deal with. And that network is surprisingly is quite big in South Africa. I mean, if you just look at the way our business has grown over the years, and that's obviously through having the right people on board and people coming out of the big corporates. The business when I joined was sitting at about 2 or 3 billion rand of assets under management, and today, through a lot of growth by acquisition, we're sitting on about 250 billion rands worth of assets. So some phenomenal growth over the last 12 to 13 years since we kind of got the business off the ground and going.
And so the people that you're speaking with, so fundamentally they're entrepreneurs. And what are the biggest problems so someone amasses wealth, they go on this entrepreneurial journey. When they accumulate wealth, what problems do you see them facing once they accumulate this money? Like at what point do they hit you?
So there's a few factors that come into the equation, and you'll be surprised how many entrepreneurs know very little about stock markets. They know their business very well, and they understand how to read an income statement and a balance sheet and how to really grow their business. But when it comes to understanding the global investment arena, the knowledge is actually quite thin. And what you're applying in your own business in terms of understanding the fundamentals, you basically need to apply that when you obviously analyzing big businesses on listed exchanges. And you've got to look for those opportunities. There's always that dichotomy of understanding the financials, making a decision on whether it's a good set of numbers or a bad set of numbers, and then trying to understand why share prices kind of look forward and on bad news can often go up, and vice versa, on good news can often come down. And it just kind of gives you the feeling or the understanding that the markets look forward in nature. And that's where a guy like me comes into the picture to try and give them an understanding of the emotional side of the stock market. Then another part, just to answer that question, is you've got to look at a whole range of soft issues, whether it's structures, offshore structures, whether you're putting yourself into trusts and companies offshore that cater for things like estate planning and longevity of the wealth so that you can ultimately pass it down to the next generation and hopefully the generations after that. And then taxation. That's very important. You've got to look at all these different jurisdictions and how you actually set up the ultimate, nest egg that's going to invest in liquid assets and ultimately grow. So a whole lot of soft issues as well. Understanding the families and understanding the clients is very important. Understanding how the money needs to actually flow from one generation to the next is very important. So there's a whole component to actually acquiring these high net worth clients into what ultimately builds a business of these clients, where it's not just the investing side of it. There's a whole lot of soft issues that these clients need to consider. And along that journey, it's also important, if you have a liquidity event in rands, which is our local currency, how do you get that out? And you've got to go through the process, through the regulatory authorities to make sure that you do it above board and take it out the right way and ultimately settle it in the right structures in an offshore jurisdiction.
So a lot of our students and our students that are here in the training cafe and the training academy, they're in a position where some have already amassed vast amounts of wealth. We've got some, very, very wealthy students. We've also got students that are beginning that journey. If you look at the clients that you work with that have amassed wealth, the entrepreneurs that you've been involved in, you yourself are an entrepreneur as well. What are the core characteristics that you've seen that these individuals develop and demonstrate as they work their way through life? What are some of the core themes that you see with these entrepreneurs and these people that amass large amounts of wealth?
I think if I sort of step back and look at it from a bird's eye perspective, I think you've got to stick to what you're good at. And I think that's kind of the overriding theme, is these entrepreneurs that have created or amassed wealth away from the stock market and are looking to, call it, diversify their asset base and look at listed investments or stock market investments. What they've done is they've stuck to what they know and they've stuck to what they're good at. The other thing that they've also done very well is they've surrounded themselves by very smart individuals. So if you don't know something, then find the person who does and surround yourself by them to get the best advice and the best expertise in a particular field. And actually, the same principle applies to me in my career. There could be a certain theme in the stock market. Let's call it a emerging market theme, and let's say China is very hot as a potential investment, and there's a lot of stimulus coming through. And do I put money there? And what are the companies to buy? I might know 2 or 3 or 4 or 5 good quality companies which make up sort of your mega cap part of that index or that particular stock market. But if I don't know, then I need to go and find the fund manager that does know and who actually is an expert in that space, and that's all he does. So I think knowing what you don't know is a key ingredient to looking for the best advice and the best direction, and it just really fast tracks to the learning curve as to where you actually ultimately want to go at the end of the day. So I think, to answer your question, it's surrounding yourself with the right people, smart individuals, and knowing that you don't know, and passing that on to someone who does, and using the opportunity to learn from an expert is really probably the best thing that these guys do.
Interesting. So if I kind of put that into my own words, it sounds like you're saying it's consciousness of kind of your abilities and consciousness of yourself and where you sit within the world, within the sphere of making money. This is what understanding what you're actually good at and what you're not, and be aware of that.
100%.
Yeah, it's interesting because
expert-led education, basically, Zach.
Right. Well, I mean, I think it's interesting because I think it's so easy for people to be so engrossed with their own world. And it's difficult to see how we actually fit into the bigger picture. And it's just, actually to be, what you're saying is to be really successful. Fundamentally, we're speaking about entrepreneurs, the people that you engage with, but they stick to what they're good at, but you need this extra level of consciousness to know what you're good at, right? And to be able to look at yourself with honesty and say, these are my strengths, these are my weaknesses, and fixing those, I guess, with people.
I think it's a good point. And, again, it comes back. And one of the reasons why I love the stock market so much is it's just driven by human psychology at the end of the day. So, the psychology behind it is that if we are doing an event or a race, and I say, well, where are you weak? Is it when you're starting the race, or when you're finishing the race, or is it in the middle of the race? And you tell me, well, my starts are not that great. And the human psychology would be, well, we need to work on this and focus on this. So the advice that you're giving is focusing on your weaknesses. And that's actually, to me, and it's an opinion, is the wrong advice. If your finishes are excellent, well, then let's focus on your strengths and let's actually make that the component that's going to make you win the race, as opposed to focusing on the weaknesses. So it's amazing to actually understand the human psychology behind all facets when it comes to the stock market and making certain decisions, because often when you self-reflect, you say, well, this is my weakness and I need to focus on that. And it's actually contrary to what you should be doing, which is focusing on your strengths.
Very interesting. So what's it like managing such a large sum of money?
Look, there's a lot of pressure. I mean, it's great when the good times are good. You can look like a hero, and you don't need to do too much to kind of get that going. So, the most important thing to do is to have a balanced profile. You can't just put a particular client's wealth all into a high risk product or a high risk solution. You've got to make sure that you balanced, and obviously there's a lot that's happening macroeconomic wise. Interest rates are high, interest rates are low. Should we have a bit in the bond market? Should we have a bit in cash? It's all about real rates of return ultimately at the end of the day. So I think, to be honest, it's not as stressful as what one makes it out to be, where if you've set the asset base up correctly, you ultimately, the end goal is achieving consistency. So if you are getting consistent real rates of return, which is obviously above inflation, and you're getting some real growth, ultimately you've actually got to rely on the seventh wonder of the world, which is compound growth, because that is really what delivers significant wealth over the long term. And when I say long term, 7 to 10 years. So, the first step is saying, well, how much above inflation do you want to achieve? Is it 9% in dollars? Is it 11% in dollars? You're going to have years where the stock market does 20%. I mean, since Trump announced all these tariffs, the stock market must be up sort of 30% in the US. So, am I going to chase the 30%? Well, I don't need to. But if I'm growing in real terms and I'm kind of protecting the capital in a downward sort of environment, then I'm achieving the consistency that I'd like to achieve. So I think the most important thing is keeping clients informed. When you sit as a professional in this industry or in this game, often when things are tough or things are bad, or you make the wrong decision, because you're never going to get every decision right. You are going to make some mistakes. It's about putting your hand up, standing in front of the client and saying, okay, well, this was a bad decision. Let's wipe it, move it, and let's look at the right decisions, again, focusing on the strengths and saying, let's move on and make sure we're achieving the real rates of return. So often when it's tough, a lot of wealth managers or client-facing people in my game tend to get quiet. And that's often the time where you need to be proactive in front of them. And often you find that they say, oh, well, I've actually got some more money I need to invest. Let's get involved, So it's about just kind of being over-communicative during the bad times. And you'll find that in the good times, you don't need to actually celebrate the wins. It just kind of looks after itself.
So there's this, I mean, that it kind of feeds on from what you mentioned before about this consciousness of your strengths and your weaknesses. And that's just this internal moral compass of honesty. And when you operate like that with the people that you're working with, it serves you in good stead long term. I'm curious about how you see the world of investing in general, because there is a million options for people when it comes to pension funds, when it comes to investing in their own, them individually going and, buying stocks for the next 20 years. How do you see the landscape right now when it comes to investing and just in general, when you see the choices that people have?
Look, it's a very different world to what it was even 5 years ago. The whole take up an inception of, call it the tech sector, has just completely evolved the world into a whole different dynamic. So the options out there are vast, and you will never find all and every single money-making opportunity. I think that the most important thing when it comes to looking at money-making ideas or looking at the world of investing is, one, you got to look at the macroeconomics and understand, well, are we in a growth environment or a contractionary environment? And you start to kind of do a top-down approach from an economic perspective, and then you slowly look at sectors and certain stocks before making those decisions. So obviously there's been a big AI theme, and we can see some mega cap stocks like Nvidia's and Broadcom's and things like that have just been absolutely unbelievably strong, and very much driven behind the theme of macroeconomics. And these are big growth companies. So what does the GDP look like in the US, for example, from a macroeconomic perspective? So take that top-down approach, identify a theme that you want to be invested in, and then within that theme, highlight the sectors, and then within those sectors, you start to identify stocks. And that doesn't necessarily have to be all in the US. It can be, from a global perspective. And slowly you start to build a handful or a basket of these stocks that ultimately talk to the theme and the macroeconomics that you're looking at when it comes to actually, building a portfolio with some money-making ideas. And if I don't know, well, then let's understand the funds and the fund managers that and let's have a look what they've got in those funds. And you know what? Let's actually phone the fund manager. I want to understand what this guy, how he actually invests his money, and pick his brain a bit, So yeah, I think it's that top-down approach that kind of helps you identify the stocks ultimately at the end of the day.
And so when it comes to expectations, I think expectations in general is an interesting topic with people when it comes to generating money and building wealth. What's been your experience with expectations? Whether it's, do people, when you enter into a relationship of managing someone's wealth, what expectations do people have with that? Like what are people expecting, and what is the actual reality of building wealth over the long term versus those expectations?
That's a great question, because often there's going to be a disconnect between expectations and what you're able to actually deliver. So I think a big part of the take on a high net worth client is it's actually also a journey of education. They need to be informed as to if they're not keeping up with the index in a particular short period of time. It's important for me to inform them that, well, guess what? There's a magnificent 7 that makes up 70% of the index. So I'm happy to go and chase the index, but just know that you're going to have a 10% weighting in these stocks. And, if the market corrects, well, then you're going to correct with it. So I think from the outset, you've always got to risk analyze your client. So I want this return, but what downside are you prepared to take? And often when you talk about the downside, they start to temper their expectations. And I'll say, well, if the market corrects 20% and you down 20%, are you happy with that? And they kind of say, no, well, I'm not. And I said, well, then we've got to give up some of the upside to achieve what you're looking for ultimately at the end of the day. And even more than that, if the market's down 20 and you down 25, how do you feel? Do you want all that risk when you want to try and beat the market? Well, it doesn't really suit them. So again, it comes back to that element of consistency over the long term that you try to create, where you protect the client wealth as much as you can in a downturn, and then in an upturn, you kind of dial up the risk a little bit, but be mindful of the fact that that dial needs to be shifted on an ongoing basis, depending where the overall sentiment of the stock market actually is at any given point in time. There's things like tax consequences that you need to take into account, etc. So I think the sort of overriding comment is that when you take on an ultra high net worth client, it's all about over under promising and over delivering. So if you can under promise and over deliver, well, then you're golden. So like you've got to, whatever your expectation is of yourself, well, dial it down a notch or two just to make sure that expectations are ultimately met at the end of the day. So it's also a big challenge to take a long-term investor's mindset from understanding that markets will correct. It could correct in 3 months, but we're in this for 5 years plus. We've got to see it through. And if it does correct, well, then get your cash ready. We've got to start buying, and we've got to buy the right stuff. So yeah, it's an educational process with the client as well on an ongoing basis in terms of bringing the client up to speed as to what to expect out of the stock market and ultimately out of their portfolio at the end of the day.
So that leads me to a follow-up question. So let's say that we've got someone that's listening right now and this piques their interest and they're like, okay, I would love to get into the world of managing millions of dollars, but they're just starting out. If we could kind of lay out some of the core principles of what a good wealth fund manager looks like, what would they be? What if we could kind of paint a mental picture of that individual so they know what to gun towards and what qualities to start developing internally, what would that look like?
So the business, it's always a very from the outset looking in, or from the outside looking in, it's a very sugary, looks nice kind of profession. But it's a profession that takes years to build. It doesn't happen in 5 years or even 8 years. It's a real commitment to understanding, just like a stock market portfolio probably achieves most of its wealth creation in the last, say, if you look at a 40-year cycle, most of that wealth creation will happen from year 35 to 40. And the same principle applies in the profession, where it takes you time to build up a book of clients, to build up that asset base, and through referrals and building up your network, etc. But you really don't get or see the ultimate cherry on top until you're at the latter part of that book build over many, many years. So it's a real commitment. It's not something that you can just flick on the switch and expect money to flow to you. I've met lots of fund managers out there that have got such amazing performance in their funds, but just can't understand why people don't put money in it. Obviously, you need a sales aspect to it to obviously attract the flow, but it takes time, and you really get the benefit later. So it's a long-term journey, and it's all about consistency at the end of the day. You've got to have that goal in mind, and you've got to put your head down, and each day you've just got to look to achieve more than what you set out to achieve the previous day, and it's hard work.
And so you're saying, first of all, having a long-term mindset around it. So if you want to get into the game of managing people's wealth, this isn't something you're just going to flick a switch and automatically start doing tomorrow. It's something that it's going to take a long time to develop, getting your book of clients up top, and then consistency. So when you speak of consistency, like what does that look like to you? What does a consistent individual look like? You mentioned a little bit, but I'd love you to expand on that. What does a consistent person look like to you?
Look, I mean, it's all about your own personal personality ultimately at the end of the day. So you've got to be. It's all about routine and sticking to what you know, sticking to your strengths, and making sure that having a routine in place builds success ultimately over the long term. So consistency, whether it's waking up early and you've got your process and you looking at the market and you looking at charts or whatever it may be, having a consistent process is probably the first ingredient to creating ultimate success. And it doesn't necessarily have to be in this industry. It's all about routine and being consistent with it and working hard, every day to try and achieve more than what you achieved the last day. So, I mean, I wake up very early in the mornings, for example. That's just my routine. So I'm up at 4:30 every morning, having a look at the markets, having a look at what happened overnight, catching up with the news. By the time I'm in the car, taking my kids to school or getting into the office, I've kind of got a psychological picture of which way things are going to go for the next 24 hours from a global perspective. And I kind of then slowly, as I'm driving and I'm getting to work, building up almost like a watch list of things that are going to react to certain informational, news items that are out or whatever. So that's kind of my routine. And by the time that it gets to US market open, and I've kind of watched the reaction and what have you, I tend to tap off and say, okay, I've kind of made my decisions for the day, and that's what I need to do. And I'm happy with things are. Could be wrong, could be right, but I've got to stick to it and stick to the routine and stick to my process.
What's really interesting about this is that I think on the surface, if someone hears that, they'll be like, okay, I've heard it before. Routine, consistency, those are words that everyone knows. What's actually going through my head is, so we recently brought on a new trader and instructor, Brent Carlisle. So he's a vet. He's been trading successfully for 20 plus years, macroeconomic investor. And we recently dropped, he's got his second module being dropped tomorrow. Tomorrow. But his first module is live already in the academy. But the interesting thing is working with him on that module, he basically described what you just described now. So if you go and you watch that module, he basically, his whole ethos is about his daily routine. And this is what he does every single day. And I think that the reason why I think for those listening and watching this, it's so important is because I think when people get into the world of trading, investing, making money, they're looking for these magical things, these like this thing that's going to like automatically make me $1 million tomorrow. And what we're actually saying is is the routine, dude, is going to be your best friend. It's what you do every single day over the long term is going to be your friend. And another thing that comes to mind is we had our all hands, which is our big kind of, company-wide meeting. And Alex, one of our traders, I mean, it's one of the biggest revelations that I had working with him closely. It's like what actually sets him aside from people that are unsuccessful. One of the key things is his routine and how consistent he is and what he does with that routine. And so it doesn't sound sexy. So it's interesting. It's interesting hearing you say that.
Yeah, it's important. I just found in the early part of my career, when I didn't have routine, or it makes you more emotional. And when you become emotional, you start to make irrational decisions. So when you step outside of your routine, you tend to act more emotionally and with more personal belief in terms of conviction. And you don't have that kind of self-reflection to rationalize with yourself in terms of making fundamental decisions that are ultimately good. And that could be from position sizes to, what stocks you're choosing, why am I chasing this, there could be a particular stock that's just gone through the roof and you're like, well, which is the next one? And it starts to become an emotional decision. And when you step outside of your routine, you start to make mistakes on position sizing, and you start to make mistakes on the stocks that you're selecting, and you start to question yourself. When you start to question yourself, that starts to become irrational behavior. And it's irrational behavior that causes stock markets to spike and to drop. And it's in those moments of irrational price action where smart money actually starts to come in and make money, where if you've got routine and you've got rational behavior, you can see the irrational price movements in markets, and you can see irrational hype towards a particular sector or theme, and you can react towards it, you know. So the routine is probably the base to allow you to make very rational decisions.
It's uncanny, the similarities between. So just for the reason why I'm loving this is because to build a module, me and Brent had to sit there for hours and hours and hours and hours when we're going through all these questions. It's like this, you know, on crack. It's like a multi-hour process to really just. But essentially, you know, he describes the same thing. He describes this idea of setting your routine and what you're looking for. When you have that, you're able to see the fluctuations. It's like if you know what's going on and you have that consistency, you can see the inconsistencies that are happening in the macroeconomic climate. So, yeah, very interesting stuff. So, how do you see the markets when you look at the markets? What's your philosophy towards the markets, movements of the markets? How do you see it?
I must say, since I've been in this career in this industry, all sort of professional market participants have tried to kind of make it sound very complicated. And they come up with all sorts of terms, whether it's derivatives or option structures or call put structures. You know, they come up with these crazy terminologies that just actually confuse the man on the street in terms of what they're actually doing with their money ultimately at the end of the day. So if I could break it down, I've always kind of kept it very simple process in terms of how I look at the market. And, you know, you're always going to get fundamentalists, you're always going to get technical analysts, and the one overriding theme that doesn't get spoken about much is obviously sentiment. So when I look at the markets, you've got to look at the fundamentals. I've got to understand, you know, what PE is this business on, and what does the cash flow statement look like, and, you know, how much R&D spend are they spending in order to generate some future cash flows and future profits, you know, and kind of where are they in the J curve in terms of growth and spend and cash flow generation ultimately at the end of the day. So understanding a business fundamentally is the base. Then you've obviously got to look at it from a technical perspective, because often, as I said earlier, you know, markets will, in fact, they will always look forward. It's just how far forward they look. So often you'll get fundamental results that are terrible and the prices will go up, and they've been going up if you look at the technicals and vice versa. So, you know, the technicals always give you insight as to what the fundamentals probably look like in the future. But what technical analysis really is it's just taking past data points, plotting them into a graph, whether it's a bar graph or a line graph. You then apply things like oscillators and volume and things like that. And you look at all the technicals that make up technical analysis. And what you're trying to do is then come out with a degree of probability of where this graph is going to go in the future. And you could be wrong or you could be right. But with technicals, the probability, it's a probability. You're never going to be 100% right. So you've got to marry the fundamentals with the technicals. And then the one side of the market, which I think is probably the one that I find most valuable, is the sentiment, the emotional side of the market. So if I could describe trying to read the market from a sentiment perspective, it's like looking at a pendulum where it swings left and right. And, you know, when it swings left, let's assume that's very negative. And then it swings right, let's assume that's very positive. It's always going to be somewhere in this space when the pendulum swings. So you've just got to decide how overly negative the market is, or how overly positive the market is, or is it neutral? And that is really the way I would describe it, is just having your finger on the pulse and trying to dissect the mood of the market and the sentiment, because that will always help you when you marry the technicals and the fundamentals to execute correctly on timing. is understanding that emotional side. Because if you look at what makes up the stock market, yes, you've got financial statements, fundamentals. Yes, you've got technicals telling you and making a high probability prediction as to where something is going in the future. But when you look at that sentiment side, you start to understand whether you should be chasing the market or whether you shouldn't. And that then gives you the ability to rationalize on position sizing, and you can look at yourself critically as to whether you're making an emotional decision or not. Because it's humans that are ultimately pushing the buttons and buying and selling shares. For every winner, there's going to be a loser. So all of those decisions, like it or not, are driven by emotions. So they could be smart emotions or they could be irrational emotions. And it's about understanding that sentiment and the emotional behavior of the market that allows you to look for money-making opportunities in the short, medium, and long term, to be honest.
And so how how did you go about learning this, the sentiments of the market? How did you grow into a place of getting in tune with that?
I think it's just through time. A lot of mistakes. Again, understanding how to read a graph, for example. If you're looking at a bar graph and you've got, a big reversal candle, let's call it a hammer or whatever, it's understanding what that hammer means. Like, obviously it's going to open up flat, sell down, and then most likely at the end of a particular trading day, pick up and close likely on its high to develop that technical reversal. But what is that emotion telling you? It's often a fight between buyers and sellers that ultimately the buyers win at the end of the day, which triggers that big move to the upside or the following days or whatever it may be. So it's looking at the charts, understanding the fundamentals, and through experience, actually understanding the emotional psychology. Because often and that's a good case example, is a hammer formation. When it sells down to that level, there's been a few days of selling pressure that's actually taken it to this level, and now it's like flushing through a support line or something like that. And it's your ability to see if this is irrational behavior. And obviously you want to wait for the confirmation, but when you look at the price action in the market through a bit of experience, you can see that this is forced selling and there's stop losses and all sorts of things that are happening to actually take it down 3 or 4% before finishing flat. So, it's probably time and experience that's gives one, and you've got to keep learning. There's often things that I don't know, and that's why I actually do love the stock market. Is every day is different, and you've got to keep learning. So, there's always going to be something different that you didn't know. So, a bit of time in the seat and a bit of experience has taught you to read through and understand the emotional side of the market.
So, understand the basics of companies. Get to grips with fundamentals. Get to grips with technicals. Get to grips with sentiments. Give yourself some time. Let yourself make mistakes, learn how to read a graph, and then learn how to communicate with wealthy people. And that's kind of the formula to get to where you are ish.
Yeah, I guess so. And hard work. You've got to have that discipline and routine.
And routine, of course. I missed the big R, routine. So when you think of hard work, what does that look like to you?
Well, you've always got to work smart. If you're working hard, then make sure you putting the hard work in for the ultimate runs you're trying to achieve at the end of the day. So, you know what? Hard work is all relative. If you're doing what you love, you're not really working. So you've just got to, you're always going to go through periods where you don't want to do certain things, and there's going to be things that irritate you. I can't do administration, or I can't do that. And you've just got to work smart, but be prepared to sign up for the journey, and that's basically working hard, is enjoying what you do so that it gives you the passion and the motivation to get up early and to actually make a difference.
enjoy what you do. And so with your being in the position where you are, what are the things that you enjoy the most? What excites you, and what gets you up in the morning and gets you ready to rock and roll?
Shit, I just love the stock market. I mean, understanding the push and pull factors that obviously give you the prices that you see on screen is just the most amazing thing to see. And, it's understanding that emotional side of the stock market that ultimately makes these prices is fascinating to me. So I, I love the feeling of being able to try look around a corner, whether it be a particular theme or whatever it may be. We've had a huge run in things like platinum and palladium lately. Um, and I was looking at the lease rates, for example, and the lease rates on platinum and palladium were just going through the roof. And that basically just means that the futures market was much higher priced than the spot price of the market, where people were locking in forward contracts and being prepared to pay extremely high lease rates for it, which was kind of indicative of higher prices to come in those underlying commodities. And being able to identify things that may affect prices 2 months in the future is really what drives me, is being able to look around that corner and say, okay, we need to buy this. What are the shares that are going to be most positively affected in this scenario, for example, and identifying those opportunities. And another good example is when Russia invaded Ukraine, and obviously that caused so many sanctions across the world, or the follow-on effect, and basically gas supply was cut off to Europe. Gas prices went through the roof. The follow-on effect was coal prices then quadrupled. And, you look at some of the listed coal shares that were obviously exporting to the Eurozone, and all the coal power plants all of a sudden came back online because it didn't make sense to run things with gas because of limited supply and also the gas price. And all of a sudden, these shares they could have done like 8 times, in terms of price from that one reaction. So whenever you get these political events or world events that affect the world from an economic perspective, it's about identifying who the winners and who the losers are. And that's the game that I love, is looking at the news, the world events, and where the money making opportunities are. They may not be today, but today is the day to position for 2 months in the future, which is or 3 months or a year or whatever it may be. That's kind of the fun that I love out of it.
What I think is so awesome about that, and for our listeners, this I think is a key takeaway from this, a subtle one, but nonetheless important, is that when I asked you, I said, what gets you up in the morning? You didn't say making money. You said I love the stock market, and I think it's a core theme across every highly successful person that I come into contact with. It's not like they don't care about money. It's not like money isn't a driver for them. But actually, there's always this thing that sits beneath money that gets them really excited. It's the game that sits beneath it that makes them excited. And the actual end result of that is that you end up making money. And it's this concept of focusing on the process versus the result. If you focus on the process, then you end up getting the result. And I think that's awesome. And so if someone is just getting into the world of trading right now, obviously we're big advocates for structured education and learning. What advice would you give to someone that doesn't necessarily want to be a wealth manager? They don't want to manage large amounts of funds for wealthy individuals, but they just want to get into the world of trading. What advice would you give to that person?
I think you've got to love the stock market. If you don't love it, it's actually not about money, because particularly in trading, particularly when you come in as a first-time trader or within your first 1 or 2 years, you're always going to celebrate your wins. It's such a nice feeling because you're making money in inverted commas. And yes, it is, but the process is actually about celebrating your losses, because it's the losses that actually make you learn. Because you then can look at yourself introspectively and say, okay, I was emotional there, or I was irrational, or my position size was too big. There's a whole range of different factors that make those decisions. Because in the world of trading, particularly if you're a new trader in the first year or two, you're going to make losses. There's no one out there with 100% win ratio. It is part of the game. And obviously, you want to try and get your win loss ratio much more in favor of the wins. But if you apply the right money management processes, even if you sit with a 50-50 win ratio, you can still beat, from a monetary perspective, some of the best traders out there if your money management is done correctly. So I would say that you've got to be really passionate about the stock market. You've got to then start upskilling yourself in terms of understanding what's driving prices. That could be macroeconomic, it could be political, but really that gives you an ability to have your finger on the pulse when it comes to understanding the sentiment of the market, and allows you to make very calculated decisions, bring the money management into it, accept the fact that you're going to have losses along the way, celebrate the losses, and be honest with yourself as to why. And that then ultimately makes you much better and sets you up to be, in 10 years' time, one of the best traders out there.
So this again is a recurring theme. It's this idea of consciousness about your weaknesses and your strengths, and having that ability to look at yourself with an honest prism.
Exactly.
versus blaming people. Cool. So a couple of questions just to finish off here, and I'd love to open the doors up to some of our students if you'd like to ask some questions as well. But a bit of a curveball question here, and I'm just curious to know what you'd say. But what is one belief that you hold about trading or finance that others may disagree with?
You don't have to be the smartest person to make money in the stock market. It's often the people that actually keep it simple that are the most successful. So, whenever I meet a new employee coming in out of university, starting their career, and I ask them, okay, so what have you studied? And they've got a long list of qualifications that they've achieved. And often it's those long lists of qualifications that kind of take you a long time to find your edge in the industry. And most often it's the students with like a simple degree that have just got a passion for the stock market and have got a very simple way of actually looking at it that makes them successful. So to answer you, I would say that you don't need to be a chartered accountant or the cleverest or the top of the class. It's how you achieve what you ultimately want to achieve through passion that makes you extremely successful. So I don't actually look at CVs. I look at people, and it's their ability to answer questions simply, and their ability to rationalize in a very quick and formulative manner that allows them to develop a very, very good edge in this game.
I love that. It actually hits home, not to derail what you've said, but it does hit home personally to me, because there's a saying that I've said my whole life, which is I may not be the smartest guy in the room, but I'll outwork you. And so, and it's, yeah, that's awesome. And so I guess my final question, just to finish off today, and I really appreciate the time, taking the time of your day to speak with us, Deryck. And it's not something you had to do. You did it out of your own goodwill, and we really appreciate it. And I'm sure our students here both those that are watching now, and I'd like to say hello to our future students as well. Very much appreciate your time and bringing your expertise to us as well. If you could send a message back in time to young Deryck, what would that message say?
I think as I started my career, it was in a very emotional start where I couldn't get to grips with the fact that I was wrong in terms of loss aversion, or I was very critical on myself with the mistakes that I made in the early days, and it took me a while to really understand that these were actually the best things that happened to me, but I should have learned more at the time with the mistakes that I made, where I could have looked in the mirror and said, you know what, these mistakes are 100% welcomed. Like, what have I learned from this? And what's going to make me better? And it's that change in attitude that happened a little bit later in my career, where I welcomed those mistakes to make me better at what I do, where I was a little bit too critical. I didn't like the fact that I lost money in the stock market, or that I made a bad decision, or that I didn't get a particular client because I just didn't win the client. And I was very critical on myself instead of saying, well, it's happened, it's going to make me better. So, like, what am I going to do to make me better tomorrow? So it took me time to be able to accept losses. And it doesn't just mean losses in the stock market, losing a client, stepping out of routine, whatever it may be, and it happens. We're all people, we're all emotional. And it was a process for me to understand the emotional side of myself, to develop a degree of consistency, which really started to come through in the latter part of my career. And I would probably say, if I could advise myself, is just welcome the mistakes, welcome the losses, but learn from it, and learn quickly from it, because you're going to be better tomorrow.
Right. I love that. That's awesome. So guys, if you want to be managing this type of money, then I suggest you hit rewind on this. You go back with a pen and paper and you take serious notes. You look at yourself and you ask yourself the question, what can I do today to start implementing these habits, these mindsets that Deryck's spoken of today? Very, very insightful. I really appreciate it, Deryck. Genuinely, I think it's been a very, very insightful, fun conversation for myself and our students for sure. Is it okay if we open up the floor a little bit and grab some questions from some of our students and see if they're here?
Of course.
Yeah.
All right, guys.
Got a few questions that have come through already. So the first one's from Angus, who said, what indicators or signals do you trust the most across cycles? And where do you go for your market landscape?
I think it comes down to the macroeconomic understanding of the overall economy. So, for the first time in many years, we looking at the developed world with a very high inflationary environment, and like, what is the follow-on effect from that? So it's looking at macroeconomics that ultimately builds a base for me to, like, 10% of the decision is actually the stock decision. It's understanding the macroeconomics and how that's going to affect. I mean, we've seen the gold price run up 40-50% over the last 18 months. Why? And really it's as simple as the fact that there's limited supply. We're in a high inflationary environment, and people or investors are looking for something that's going to protect them against inflation at the end of the day. And we've seen a massive move into that gold, as well as Trump coming in as president. The dollar's lost some of its shine. So where is that money been going for the last 12 months? So it's just identifying those macroeconomics that acts as an indicator for me, in terms of identifying a big base before making the actual stock selection. And then in terms of getting the data, I mean, obviously we got access to Bloomberg, and we got access to it's amazing how informative X is as a platform in terms of market news and market information. It's talking to people in the industry, talking to fund managers, talking to CEOs of listed businesses. You got to be bold and brazen and put yourself in front of people that you ordinarily wouldn't put yourself in front of. So, I think you've got to use a whole spider web of feelers that ultimately build a network at the end of the day.
It's what Warren Buffett did when he first got going. Is he went and I can't remember the sector, but he went and visited just a bunch of different companies in X sector, and he said that by the end of that round of interviews, he knew more about their industry than they did. So interesting. Next question.
Yeah, so you kind of answered this question just now, which was it says by anonymous attendee, but it says, how do you stay up to date with all the macroeconomic and sector changes? And you just said X is actually a great place for that. But then they also added is, I always get overwhelmed or confused. Appreciate you can give some guidance on this. So I think the question is, there's a lot of information and you're only human. How do you take that in?
So remember, you ultimately making a decision for like a money-making decision at the end of the day. So you can decide to surround your world with chaos or not. And there's a lot of chaos out there. You can decide where you're going to get the key pieces of information that are going to build your 50 to 60% base from a macroeconomic perspective to ultimately make your stock selection. So to answer the question is, don't get caught up in the chaos. You find certain information feeds, whether it's on X or whether it's a few comments here or there. The internet is a huge place. And you follow it and you stick to it and you detach yourself from the noise, and you kind of stick to your process. And again, it's got to be simple. If you can come up with a simple strategy, that's ultimately going to create success. Don't let the market participants confuse you because they're all emotional. They all come up with some highly technical terminology that just confuses you at the end of the day. All you ultimately want to do is, do I buy, do I sell, or do I hold? It's that simple. So feed yourself with the right avenues of information and just keep it simple.
So if I can just add something there. So rock and roll and do this, anonymous attendee. But I would, if this is something you want to do, I do suggest you sign up to the Quick Win program, because we dropped a module titled Institutional Grade Fundamental Research, and everything that Deryck is saying right now is mapped out in this module, and it walks you through what to look at, what news feeds to look at, how to navigate vast quantities of information, and figure it all out. So if you do want to do that, join the Quick Win program. It's worth it. Do it. Sign up. Make it happen. I just wanted to make that quick plug.
No, I was going to say the same thing because Brent actually trades in a very similar way to you, Deryck.
Yeah.
Very, very similar. So Pete Nealis, I remember him from last year when we were doing the reading of the book. But it says, obviously, we're all retail investors in here, trading with a relatively modest account size. What would you say are the unique aspects that can make us small players successful versus all those big institutions out there?
Consistency. Don't go chase the million in one day or the big profit, or try double your account in a week, because that's emotional. The seventh wonder is compound returns. If you can do 2% a month, you're achieving great returns and you're achieving a great outcome. That's a phenomenal return. Ultimately you want to tweak that and make it a bit better, obviously in the right environment, understanding the sentiment of the market. When the pendulum swings positive and the market runs, it can stay overbought for a long time. Ride the wave. That's when you want to start managing and taking on a bit more risk and maybe chasing slightly more returns per month, 2 to 3%, maybe 3% per month. But if you're achieving 2% per month consistently over the long term, the compound returns are going to generate a massive account. It's just time in the game.
It's very interesting what you said there in terms of 2 to 3% per month. It's exactly what we have in our book and what we talk about in the thing, because a lot of people go for 10 to 20% a month. We said, actually, if you want to be really rich, you need to learn how to do 2 to 3% per month. However, you have a lot of super, super rich clients. And you told me once that they don't actually all want 35-40% per year returns in everything that they do. You said you actually diversify them in a different way.
Yeah, 100%. To achieve 35% in any year, you've got to accept the fact that you are taking on a significant amount of risk. So, a crisis can come unbeknown. You cannot predict that. The financial crisis, the COVID crisis, we can call it the Trump crisis when he held up his tariff board. Like, you can't predict when that happens and how quickly and how sharp that happens. And you don't want to be so overly invested in risk assets that causes you to participate in more than the market downside in a short space of time. It's going to stress you out. It's going to make you emotionally irrational, and you're going to make some really bad decisions. So my clients, when you're sitting on a big sum of money, I kind of educate them to a point where let's get the consistent real return that we're trying to achieve. I don't need to get 20 or 30% a year, but I do need to get you 11 or 12% year on year. And if I can achieve that on a massive asset base, the compound return is far greater than trying to chase big wins and kind of making irrational decisions in short-term downturns. Like, that's not my game. So that's when you introduce other facets like bond markets and money markets, depending on the macroeconomic environment, and alternative funds.
It's very interesting because inside of the book, we actually state that the higher your account goes, the more money you have, generally you start reducing your risk. And how really, really rich individuals trade will be probably very different to, or how money gets managed and how it gets diversified. It's probably very different to when you have a smaller account. So do we have time for more questions?
While that's happening, I just want to just shout out to our students in the academy that are trading live right now. And I know I've seen a few in the comment box that are doing that. So just to put things in perspective, 3% a month is around 43% per year compounded. So what Deryck's speaking about is like 1.5% a month, 1% a month. And a lot of you guys are getting that right now. And so on paper, you may think to yourself, well, it's only 1% a month, but on the grand scheme of things, these are phenomenal returns, guys. And so be very proud of what you're doing, the fact that you're achieving that right now. So I just wanted to shout out to our Academy Live students that are trading the markets right now with that. Cool.
Yeah, absolutely. All right, so there are some more questions.
Cool.
So how do you, so this is from Danny. Danny, I don't know how to pronounce that. Yochard Duplessis. How do you protect high liquidity portfolios against market drawdowns or crashes today?
Look, you're never going to 100% protect it. So if there is a drawdown, you can expect the portfolio to have a drawdown. It's just how much of a drawdown, I think, is really the question. So if the market's down 10%, I'd like to sit in a position where my clients are only down 4 or 5%, because that, to me, is outperformance. Well, it is outperformance. So how do you protect it? Well, again, it comes down to understanding the sentiment of the market. Right now, the sentiment of the market is extremely positive. And you'll probably find that a lot of the retail investors out there are just buying and want to get in. And it's probably the time to start raising a bit of cash and having some cash in the back pocket if there is a bit of a downturn. or putting some protection structures in place that allow you to protect the capital that you've made in the short or medium term. And that could include things like option structures that allow you to kind of take a hedge on the market if there is a downturn. So either building up some cash, which is kind of the vanilla and simple way to do it, or kind of putting a hedge into the portfolio to kind of allow you to continue participating in the upside of the market to a certain point. But if there is a downturn, you're protected, not 100%, but a lot more than if the market corrects. The market should correct more than what the portfolio corrects ultimately at the end of the day. So, and then it comes down to risk management. How big are your position sizes? Is it prudent to, if you want a 6% weight in a particular stock, is it prudent to jump in with the full 6% now? Probably not. Maybe you start to build it slowly, and you never know where it's going to go tomorrow, the market, but let's start with 2%. And if it comes down, well, then we can add more, and we're getting some better pricing. If I like a particular stock today fundamentally, and it falls tomorrow or the next week or the week after, then I've got to say, well, then I like it more. Or what has changed fundamentally for me not to buy it? Because if I'm not, then it's an emotional decision.
All right. Okay. So we have one more question from Paul Holman. He says, very well spent hour, gents. Thank you. Would Deryck please briefly outline more about his daily routine relating to trading? So I think very, very briefly is probably the key word.
I think, Pete, so I don't spend a lot of time trading. I do some. What I do is I wait for the market to come to me. So sometimes the best trade is no trade. And often that sort of delivers better consistent results as opposed to trying to chase a trade. So I'll always wake up in the morning, inform myself through the channels. A lot of it is on X. I get a lot of information on X. I get a lot of information off Bloomberg. The business that I represent is at a size now where there's a lot of communication between some of the analysts and the market participants in terms of what came out in results overnight. Then I look at underlying fundamentals, where commodity prices are, where are currencies, and what stocks are going to be affected on the back of this. And is the oil price up? Those kind of things. So I kind of come into my call it trading day with a view or thought process, and things may open higher or lower. I'm not going to chase it. Often what I also do is I look for abnormalities in the market. So again, understanding the psyche of the market and waiting for the prices to come to me through irregular price action often allows me to take advantage of that. So I might not trade for 2 weeks, but when I do get an opportunity where I see irregular price action for whatever reason, then I'm prepared to take a bet on it and to say, okay, let's now make some money. And maybe that stems into a quick 5% type trade, but it doesn't happen often, and that's how you kind of generate those 2% from a trading perspective, at 2% per month on a consistent basis, is waiting for the market to come to you.
All right. Yeah, that's interesting. I actually, there was actually a correlation between when you trade that I've noticed every time we go for a steak on a Friday. You have your laptop open, you're like, oh, actually, it's like, sorry, Pete, I'm in this trade. So now I know it's like a 1 to 2 week thing. And then you're like, okay, I'm in a trade. I'm going to meet Pete for steak.
One thing I don't like doing is, particularly with Trump in charge of obviously the US presidency, is I don't like sitting with 2 big open positions over the weekend, because there's so much that can happen from an informational perspective between market close on a Friday and what happens on a Monday, that I tend to de-risk quite a lot when it comes to Friday, just to make sure that I can enjoy my weekend and not think too much about my position sizing or whatever it may be, where I panic and probably wake up at 2 in the morning on a Monday just to see what markets are doing, you know. So I tend to de-risk when it comes to a Friday afternoon lunchtime.
All right, wonderful. Okay, those are all the questions. Thanks so much, Deryck.
Thank
I
you,
really
guys.
appreciate it. Yeah,
and
thank you.
thanks to the Trading Academy. I really appreciate it. It's great to actually be a part of this and to be part of the community. I think what you guys are doing is great, and you know, there's nothing better to see a platform that actually gives people an opportunity to educate and to learn so much. So, you know, you guys are seriously adding some serious value to a lot of market participants and individuals coming into the market.
Thank you so much, Deryck, and thanks for being part of that. It's very much appreciated. So once again, guys, let's show some big love to Deryck for joining us today. And I appreciate your time as well as students of the Cafe and the Academy for taking the time out to hang out with us today and showing an interest in developing your skill set and growing. It's awesome. For our Academy students, keep crushing it, keep studying. And I think we'll log off now and we'll see you next time.
All right.